In this video, we're going to look at Intercontinental Exchange. And this company owns exchanges for financial and commodity markets. One of those exchanges is the New York Stock Exchange. What I do in my videos is I run my discounted cash flow model to figure out the true value of a company. And then we look at the financial ratios of the company to get more information. I do this with you throughout the video, so it's like we're doing the whole process together. So let's get started with the model. This company has a market cap of $51 billion, and that's the value of the company. And then they have a stock price of $93.30, so that's how much it costs to buy one share. And now we're going to look at the financial information of the company. First, we need the free cash flows. And free cash flow is the way you value a company. What you do is you estimate the future free cash flows, then you discount that number back to today. That's exactly what I'm doing in this video. Now I'm pulling the net income, and this is the profit and loss on the income statement. And I use 4 years of this data to put into the model, and the model does all the calculations. And now I'm pulling the revenue, which are the sales for the business. You also want to take a look at the numbers to make sure they look okay. These numbers look really good. When I say really good, I mean they're positive and they're consistent. And that's the best way to get a good valuation. They also have pretty good profit margins. I mean, it is 43% 1 year, but still 30% net profit margin seems pretty strong for a company. Let's look at that capital structure to get more information. Let's get the interest rate they pay on their debt. That's $285 million. And let's go to the balance sheet to see how much debt they have. We'll go to liabilities section. And current debt is debt due within 12 months. That's $2.5 billion. Long-term debt is $5.3 billion. That's debt due after 12 months. They pay 3.6% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. The income before tax is $2.5 billion, and their income tax is $521 million. So their tax rate is 21%. So the cost of debt is 2.9%. Let's get the cost of equity. We need the beta. The beta is how volatile the stock is relative to the entire market. And they have a beta of 0.54, so it's pretty low risk stock. When you get a low risk stock, you tend to need a less return to get value out of it. And also, it provides a lower weighted average cost of capital, which is the discount rate. Let's go back to the balance sheet and get their current assets, because we need this when we calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. We also need the current liabilities to calculate the current ratio. And these are debts and payables that are due within 12 months. And the equity, which is assets minus liabilities, that's $17 billion. And we need this number for the price to book value formula and also the ROE formula. Now let's get the EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's $2.7 billion. And that number is needed for the interest coverage ratio. So let's look at a capital structure. Cost of debt is 2.9%, and they have 31% debt. Cost of equity is 6.5%, and they have 69% equity. So the WACC, the weighted average cost of capital, is 5.35%. And that's a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows, and we did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $59 billion. We divide that by 547 million shares. And we get an intrinsic stock price of 109. It's trading at 93, so it's trading at a 14% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They say the value of the company is $74, which is less than they're trading at. So we're in the opposite direction in our models. But you can see my model is not too aggressive. Their future cash flows seem to be kind of in line with their past. So apparently, Simply Wall Street is using a more aggressive approach for this company. And it looks like the stock has been increasing pretty much for the past 5 years. It did drop at coronavirus, but it's come almost all the way back up to its peak. Let's look at the financial ratios to see if we get more information. They don't have that good of a PE, that's price to stock over earnings per share. That means investors are willing to pay $26 for $1 of earnings. Price to sales isn't too good either, 7.8. That's price to stock over sales per share. The price to book is pretty good at 3.0. That's price to stock over book value per share. So investors are willing to pay $3 for $1 book value. They're doing decent in current ratio. They can almost cover the current liabilities. ROE is a little low at 11%. That's net income over equity. They can easily cover their interest payment, and they only have 31% debt. So the ratios are mediocre. I do value the stock at a buy, but it's kind of a judgment call in this case. A lot of it is dependent on how you feel the future of this company and the future of the stock exchanges are going to do. Let me know what you think of the video. Thanks for watching.